Hello everybody, welcome to today's session of Nirvana. In the last session we had studied in detail about the 4 sections of an annual report. So in this session we are going to analyze the last section, but one of the most important sections as well, which is the financial statements. Now, like we discussed in the last session, each company might have two kinds of financial statements, the standalone and the consolidated financial statements. So we'll come back to the same example of Tata Steel, the annual report that we were going through. So there are going to be three key statements within the financial statements or the financial report section for a particular company. The first being balance sheet, the second being the profit and loss statement, and the third being the cash flow statement. Now these generally could be in any order, but for listed companies, as per the regulation, balance sheet needs to come first, but for private companies it could be anywhere at their convenience basically, and you don't need to read too much into the order in general. However, you need to remember that while these three statements would look very different from each other in general, they're actually very closely linked to each other. So there are a lot of data points and parameters and information that flows from one statement to another very seamlessly, and these three statements together help you understand the financial health and the future potential from a financial perspective before you make your investment decision. So starting with the P&L. So most of us might have heard about P&L, profit and loss statement, also called the income statement. So a P&L helps us understand whether the company has posted a loss or a profit during a particular period, and it also helps us understand what is the revenue that the company has made, what are the costs and expenditure that it has incurred to actually earn that revenue. So these are a few important points that our P&L statement can help us analyze. The second statement, balance sheet, actually helps us understand what the company owns and what the company owes, which means what are assets and what are liabilities. So a balance sheet also helps us analyze what would the money be that would be returned to shareholders if the company sold off all its assets and paid off all the liabilities, and what would be left for them to get from the company, right? So that is what you can also understand with balance sheet. So unlike profit and loss, which is calculated for a particular period of time, a balance sheet is like a snapshot in time. It helps you understand the current status or the financial situation of the company in terms of assets and liabilities. And the name balance sheet comes because both the sides, the assets and liability sides of the company, always balance each other. Now you must be thinking, if both the assets and liabilities balance each other, why would the company be worth anything? It would always be worth zero, right? So that's not the case. So company, at least a solvent company, generally has more assets than its liabilities, but the remaining amount is the shareholder equity. Now that is the amount that belongs to the shareholders. So after you have sold all your assets and paid off all your liabilities, the amount that's left belongs to the shareholders, and that is called shareholder equity. So that is why assets equal to liabilities plus shareholder equity. The third statement is a cash flow statement. Now according to me, this is one of the most important financial statements out of all the three. Again, this is my personal bias. Everybody would have their own opinion about how to look at these statements. So one of the reasons I really feel cash flow is one of the most important statements is because a company might be posting a profit, but then it may not have the cash in hand to actually conduct its business or to grow its business. Now let's take for example, if you're purchasing a particular say sofa from your furniture shop. Now the moment a customer decides to purchase a particular sofa, the company may not receive the money from the customer immediately. Now a bill is raised and there could be a small advance payment that the customer makes. Then the sofa is delivered, the customer takes 30 days to actually make the payment. But in the books, the entire revenue is already recorded as per the accrual accounting system, which means the transaction is recorded at the moment it occurs and not when the money actually comes in or goes out of the bank account. Now while on paper it is booked as revenue, the customer may not pay up in 30 days, or it could take longer, or the customer may actually default on payment. Now this is where cash flow comes to your rescue. So cash flow helps you understand whether cash is actually in hand. Do you have that net cash, or do you have the cash on books to help you grow your business? Now if there are enough clients who are taking long time to actually pay you and not actually paying up in time or not paying at all, these things could easily reflect in your cash flow statement, and then you can easily assess whether the company has enough bandwidth to keep growing. So this is a small reason why I like cash flow statement over the P&L or balance sheet in general. But then there are a lot of things that P&L and balance sheet also give you, which we'll understand over the course of the next few minutes. In terms of Tata Steel, coming back to the example that we have taken, so if you scroll down to page number 287, so that's where we are introduced to the last section of the financial statements. So if you look at the entire index, so there is a small financial highlight section, which again is a nice little addition from the management. So this is where they have calculated a few important ratios that could be of importance to investors, and they've already given the data around it. The second thing they have done is they have given some important and mind-boggling statistics about the scale and size of Tata Steel, right? So how many metric tons or tons of steel that is being produced, what part of it is saleable steel, what is forged steel, what is rolled steel. So they've given those very interesting statistics that you can go through when you have time, and I really loved going through that section, obviously. Then the next parts of the document go towards analyzing the standalone and consolidated financial statements. So as we discussed in the previous session, it starts with the independent auditor's report. In the case of Tata Steel, it is PwC. So PwC again is a very well reputed auditor, part of the big four. So the big four auditors include PwC, Deloitte, EY and KPMG. Now it doesn't guarantee that the accounts are free of fraud or they are fully genuine just because they have employed a big four auditor. But what is reassuring to us is they have hired an auditor who has the capability and the bandwidth to kind of assess a company of the size of Tata Steel. Now these four auditors are very well known and reputed across the world, and they do have the resources to actually analyze companies as big as these. There's a lot of Fortune 500 companies also that hire these auditors for their own statutory and independent audits basically. So that is a good sign. Now, because this is from an explanatory angle, we will start looking at the standalone financial statements of Tata Steel, but we'd also recommend that you go through the consolidated account as well for the company, because Tata Steel does have a lot of material subsidiaries. So as we discussed again in the last session, when the company has material subsidiaries where there is significant cash flow, revenue and profits that are being contributed from multiple different entities, it becomes important to also look at consolidated numbers. Let's quickly scroll down to page 313, where the company's standalone balance sheet has been communicated. So the first section that you see on this page is the assets section. Assets has two parts, non-current and current assets. You will also notice that the liabilities part also has the current and non-current liabilities. So current and non-current assets to begin with. So assets which are likely easily to be liquidated within the next 12 months, right, are called current assets. So these are easy to liquidate and they're going to remain on the books for a short period of time. Now this could be cash and cash equivalents, this could be a short-term fixed deposit, or this could be things like inventories again. So why is inventory on the current assets? Because it is expected that within 1 year customers are likely to purchase that inventory and it's not going to be on the books anymore. Of course, the production that happens later would again be piling up on inventory, and we cannot reasonably assume that inventory will be zero at any point of time unless the company shuts down. So that is why inventory is measured as a current asset, right? Then the other kinds of financial assets in the current asset section of assets, which is the section number 2, is investments, trade receivables, cash and cash equivalents, other balances with bank. Just like you have your personal bank balance, company would have its own current account balance. Then loans, which it has given. Again, don't confuse loans with the loans that company has taken. This could be the loans that the company has given to its vendors, maybe to its subsidiaries and things like that for a very short time. Then there are derivative assets, other financial assets and other assets in general. So these are assets that the company believes will be liquidated within 1 year, or will be converted into cash, or they will go into long-term assets. They'll be used for something to grow business or for operational activities. Now non-current assets are the assets which are long-term in nature. They're not short-term. So when I say long-term and short-term, why am I repeating myself multiple times, is because this is a very, very important concept. While current assets are on the books or the balance sheet of the company for a short period of time, that is around 12 months, long term assets are generally for the company's overall business, for their critical equipment, critical infrastructure, property, plant, and in buildings. These things are generally included in the non current assets. So if you look at the details here, so property, plant and equipment, also called PPE, then capital work in progress, right of use assets, goodwill. Now these are things that are very long term in nature, right? You don't expect property, plant and equipment to be a very dynamic number. Of course the company would be investing into newer and newer infrastructure from time to time, but they won't be bought and liquidated, because that's not the business Tata Steel is in. It will invest into a capacity or into some infrastructure only to grow its business, and not to simply buy and sell property and plants. And then again you will notice that there are financial assets again in this section as well. So investment, loans, derivative assets and other financial assets. You must be confused. There is the same financial assets in the current asset section, and again there is financial assets in the non-current assets. So just like there could be property, plant and equipment, which is a long-term assets, and inventory, which is a short-term asset, financial assets can also be short-term and long-term, right? So we also know that in stock market there could be traders, there could be investors. So in the same manner, the non-current assets part of the financial assets looks at long-term investments. So the company might have also invested in mutual funds, maybe direct stock or private equity investments, which it feels are there for the longer run or longer horizon basically. So all those are reflected in the non-current assets section. Now when you add up these two things, the non-current assets and the current assets, that's where you get the total assets of the particular company. So that makes up for the asset side of the company. Coming to the second part, which is the equity and liabilities, we'll first do the liabilities part and then come back to the equity share capital. So liabilities, again it is the same thing. There is a non-current liability and a current liability. Current liabilities are for short term, non-current liabilities are expected to remain on the books for a longer time, approximately more than 12 months. So in financial liabilities, it could be borrowings. Now these are the loans that the company has taken from outside. We all know that Tata Steel is a very capital intensive business. Again, not just Tata Steel, steel as a business is really capital intensive, and it needs a constant influx of investment to keep its operations running and growing. So you will notice the borrowings as a number being tremendously high for this industry. Now a very important point that I wanted to bring up here is there are a lot of people who generally ask me about, hey, suggest some debt-free companies to us, right? So there is a taboo around debt for some reason, and this is generally a bias which comes with a lot of other financial parameters and ratios as well, things like PE and ROC. People end up coming with numbers where PE should be less than 15, ROC should be greater than 15, and then when you look at debt, it should be a debt-free company. Zero debt is not always a great thing to have. If a company really does the math, if it has a great standing with banks, if it has the cash flow to sustain a mediocre or a moderate or optimal amount of debt, it actually makes sense to take debt from time to time. If you can use capital which is coming at 8-9% or even 6% of interest cost, and if your business has an IRR or an internal rate of return of 15% or 16%, or if your project is so lucrative, it does make sense to take outside money and also build wealth for your shareholders, and also build wealth for the economy and the banking industry, right? So the important point here is not that having zero debt is great. It's that the company should have optimal amount of debt. What is optimal amount of debt? The amount of debt where the company can comfortably service the interest charges, which is measured by the interest coverage ratio. So the interest coverage ratio measures how many times of the interest payment is the net profit of the company. So whether the company can very comfortably pay its debt or not. So this is one important parameter that you can look at. Do not worry if a company has debt. Only try to understand if two things. One, if the company is able to generate good return on its capital. So if it has raised capital in the form of debt and invested into a project, how is that project going? How is that business running? Second, does it have enough cash and generating enough profits to service its interest on time? So these are the things that you need to keep in mind. So the same concept can be applied to any other ratio, like I said. So do not distract or get confused with ranges. Okay, there is this market guru who says this is the right PE ratio that you need to invest in. If the ROC percentage or ROC value is less than 17.5, don't invest. Absolutely not. Each industry, each sector is very different. Each business has its own characteristics. So please look into the business in the context of its industry. Do not compare apples to oranges, right? Please keep that in mind when you're conducting your analysis. Now, in the long-term liabilities, there are provisions, retirement benefit obligations, deferred income, deferred tax liabilities. Now, these are the payments that the company expects to make to its employees, to government agencies, to the labor department, GST. So again, GST is again something that doesn't come here generally, but there could be some provisions that are set aside. So for a company of the scale of Tata Steel, it is very reasonable to expect that there could be a lot of disputes or litigations or pending arrears or provisions. Now provisions are things that a company believes they have to pay at some point of time, or they are likely to pay at some point of time. So they keep that money aside as a contingency fund, or you can say they're keeping that money aside because they believe they're anyway going to pay it. So they are planning well. So generally higher provisions are also a red flag, lower provisions are also a red flag, unless the company has no absolute litigations or pending commitments or any contingent liabilities that it expects, right? So this number again has to be read very much in the context of the size of the company, by revenue, by profit, and then this has to be compared to understand if the number is really bad or really low. Again, do not make any standalone or specific comparison saying, okay, Tata Steel has a provision of 2000 crores. This IT company that I was reading, which is a small cap, has around 200 crores. They are not comparable with each other, because again, the industry characteristics and the size of operations are really different. So now adding up both the non-current and current liabilities part of the balance sheet gives you the total liabilities. If you now deduct the total liabilities from the total assets, that is where you will see that fourth section in the balance sheet called equity, which is the shareholders' equity, which we have spoken about. Now this is the money that belongs to the shareholders of the company. Now in these, we are intentionally not going into a lot of other details in the interest of this particular topic, because our focus is on understanding how to analyze an annual report. There's a lot of depth that we will get to, of course, in the financial statements in the other workshops of Nirvana as well. Now coming to the other point, I had mentioned this in the passing in the last session. So if you noticed in the balance sheet, there is something called there is a column which talks about note number. Say let's talk about assets, non-current assets, row number 1A, right? So in row number 1A, there's a note number 3, page F44. Now each line item in this particular balance sheet, or most of the line items in this balance sheet, have a corresponding notes to these financial statements, which explains the entire rationale, story and details behind the numbers that are mentioned here. So this is very important that you go through these notes to financial statements without fail. So for example, if you're looking at property, plant and equipment, there is 90,806 crores of value that the company says it holds. Unless you go to the financial statement notes, you won't understand what is a breakup. How much is in terms of buildings, what is the equipment, what is the machinery, how much of it is in terms of the furniture, so or land. These are really important. So these numbers do not mean anything by themselves, apart from just comparing last year's number to this number and saying, hey, you know what, the PPE increased by around 600 crores. Which absolutely means nothing. So unless there is a qualitative aspect of a quantitative data, generally it actually means nothing, at least in the context of our financial statement analysis. So please don't forget to go through that in detail. Now coming to the next section, which is the profit and loss statement. So we start with the top line, which is called revenue. The reason revenue is also called top line is because it's at the top of the entire statement, and profit is called bottom line because it's at the end of the statement. So revenue from operations and other income. Other income is technically income that does not come from the core operations of the company. Now for Tata Steel, of course, the core operations is a sale of steel, right? But then again Tata Steel could be making money from a lot of other things as well, like maybe rental income. It could be selling power that it generates from its own captive generation capabilities and then sells the surplus power to other entities. So all these could come in the other income of a particular company. So core revenue from core operations is shown in the row number 1, and revenue from non-core operations is shown in row number 2. So this could differ again from company to company, and if other income in general is higher, that is a red flag that you need to look at and try to understand where exactly the companies are making their other income from. Is the company diversifying way too much? Is the company distracted, or why is it not making enough money from its core operations? This has to be something that you have to keep in mind. Now adding these two details will give you the total income or total revenue from operations. Then expenditure, the cost of material consumed or cost of goods sold, COGS, COGS, that is also generally called. So here the company details in the section number 4 the entire details of the expenditure that the company incurred in actually manufacturing and selling the steel worth of around 1,40,000 crores, right? So these numbers are really mind boggling. It goes on to talk about this goes on to say a lot about the scale that Tata Steel has achieved and the kind of history that company has in terms of Indian enterprises basically. So coming to the row number 5, we look at profit before exceptional items and tax, which is simply row number 3 minus row number 4, which is the total revenue minus the total expenditure. Now again you have to remember, it clearly says before exceptional items and tax. Exceptional items are one-off expenditures, or whether it could be an income or whether it could be an expenditure which the company expects that will not recur every year. This is a one-off or an extraordinary item that is being very explicitly mentioned by the management here. So any expenditure that is expected to be incurred every year goes to the traditional expenditure section. Expenditures which are one time or income that is one time goes generally to extraordinary income or extraordinary expenditures. That can again in the context of Tata Steel, it's mentioned as exceptional items, which is the same thing. Then we have row number 7, which is profit before tax. So now the total exceptional items have been deducted from the profits, and now there is profit before tax, which is 9,172 crores. Now row number 8 or section number 8 talks about the tax expenditure, which is the current tax and deferred tax. Now after deducting that, almost the profit for the year comes to, which is PAT also, PAT, profit after tax, which is 4,807 crores. So this is the actual money that the company has made after paying for taxes, exceptional items, cost of goods sold, and all other expenditures that the company has incurred. Now this is again translated towards earning per share. Now there is something called other comprehensive income, total comprehensive income. We'll get into those details in the detailed analysis video. Now in earning per share, you divide the total profit, the net profit of the company divided by the number of outstanding shares of the company, you get the earning per share, EPS, which is called. EPS forms the basis for a lot of important financial ratios, calculations, valuations. So for example, the most popular valuation metric a lot of people love is PE ratio, price to earning ratio, where you take the current share price of the company in the numerator and the EPS, the earning per share of the company, in the denominator. That gives you a multiple which helps you understand how expensive or overvalued or undervalued the particular company is. Now that ratio has its own limitations, but I was trying to explain the popularity and importance of EPS comparing EPS or revenues or profits or the balance sheet of a company with the previous years will give you a lot of more insights in terms of whether the company is actually growing or degrowing, what is the direction that the entire business is taking or shaping up. So now moving on to the next and the last statement in our financial statement analysis, the cash flow statement. So coming to page number 317 of the Tata Steel annual report. So there are three major divisions within the cash flow statement. So the first being the cash flow from operating activities, the second being cash flow from investing activities, and the third being cash flow from financing activities. So these could, again, the terminologies and the names could vary from places to places. The names of these particular divisions could change from time to time, but then cash flow from operating activities stands for the cash that the company is generating from its core operations, right? So here in the case of Tata Steel, we see that the total cash flow from operating activities, the first head within the section A, if you see, is the profit before tax. So like I had said in the start of this entire session, that each statement is linked to the other in multiple different manners. So one such example we are encountering here, where you see profit before tax. A few minutes back, we had discussed the profit before tax number in the P&L statement. So this number exactly comes from there. And then now we are going to adjust that for things like depreciation, amortization, dividend incomes, and anything that's related to the core operations and needs to be adjusted accordingly. Now in this cash flow statement, you will notice that the money that comes in is written in plain numbers and the money that goes out is written in bracketed numbers. So like we mentioned, a cash flow statement looks at inflow and outflow of cash, and that is why that representation has a clear demarcation, right? Now the cash generated from operations at the end of the section A that you look at it here is 32,373 crores. Now out of that, income tax is paid net of any refund. So sometimes there's a refund that comes from the government due to different adjustments. So the net cash used or net cash from or used in operating activities is 27,328. Again, this is positive cash that has been generated from the operations. If it were negative, which is in the brackets, it's mentioned used in, which means if the number was in bracket, it means the cash flow was negative. So if a company's profit and loss shows that the company is in profit and there is also a healthy cash flow or a positive cash flow, it means that a company is doing really well. Now there could be another question in this particular section regarding depreciation, right? So you must be thinking, why are we adding back depreciation to the profit before tax? That is because depreciation is not a real expenditure, right? So depreciation is basically the division of a cost, the cost of purchasing a particular capital equipment or an expenditure where the company believes that that particular equipment, infrastructure or machinery is going to be used for 3, 5, 7 or 10 years. They're going to divide that cost over those different years. Now why that was included in the P&L is because that's an expense that needs to be carried on the books. It was paid by the company in some particular year in the past or in the recent past, but then it has to be accounted over the next few years. That ensures that the company's profitability doesn't look too bad, and also it makes sense because the equipment which was purchased in that particular year is not just used for that year but across multiple different time periods. Now in cash flow, it doesn't make sense to carry that expense because it's not a real cash outflow, right? So that number is added back. So that is how you can kind of do the thought experiment, how cash is coming in, what is going out. And in the detailed Nirvana session on the financial statements, of course we are going to get into each line item and analyze the notes to these financial statements as well. Now coming to the second section, cash flow from investing activities, this is pretty straightforward, where the company's purchase of capital assets, sale of assets or different investments, purchase of investment, sale of investment. This could be land, equipment, buildings, mutual funds, stock investments, private equity, fixed deposits, anything, any particular investment that the company is making, or whether it is purchasing or selling, is reflected in this particular section. Now if a company is also making aggressive investments, that will be visible in this particular section, where especially in the capital assets head or the line item, because if you're looking, if say the management has announced a capital capacity expansion or capital expenditure, where they believe there's a lot of demand from customers for their product and they want to actually increase their capacity to meet growing customer demand, they need to invest into that expansion, right? So whether it's a purchase of land, getting the requisite approvals, hiring new employees, setting up the infrastructure around it. So all these things cost a lot of money. So if you look at these numbers and see that the company has been spending quite a bit of money here, the numbers are really big, then you should start getting a sense that the company is actually investing into the growth of its business. However, you should again read the notes to financial statements and follow the management's commentary as well to understand if that money is really going for expansion or is it something else. So the last section in the cash flow is the cash flow from financing activities. Now, if the company has issued any fresh shares or bought back shares from its shareholders, or there is a particular repayment of debt, or there is a new debt that has been taken into the books of the company, payment of lease obligations, utilization or cancellation of derivatives. So any financial activity. So you must be thinking, wasn't investment activity also financial activity? Now there's a difference between a financial activity or financial cash flow and an investment cash flow. Investment cash flows are generally for the long term to gain certain profits or interest on the cash that is lying in the books of the company or in the bank accounts, or to invest into its core business and grow its assets and grow its profits over time. However, financing activity is more pertaining to the share capital, how many shares were issued by the company during that year. Why do you issue shares? If you want to raise capital, right? So you issue shares to shareholders if you want to raise money from them and invest into your business. So that could be through debt, or that could be by equity, which is through issue of shares, or the company, if it has excess cash, it could also buy back shares. So this is also mentioned here, proceeds from issue of equity shares, that would be mentioned here. Then dividend paid, interest paid. So if it's raising, if the company is raising debt, then it has to pay interest on top of it. Then repayment of long-term borrowings, any borrowing that has been taken by the business that has to be repaid at some point of time. So the company might have raised debt 3 years, 5 years back. It may be maturing now, and then it is time to repay the entire principal, not just the interest. So the company's repayment transactions are also visible here from time to time. So now if you add up these three details, so net cash used in financing activities is around negative 8,414 crores. So if you add up all the heads, the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities, you will get the net cash of the company or the net cash flow of the particular company. So now if you notice here, so opening cash and cash equivalents here means the cash that the company had at the start of the year was 1,185 crores. Now add to that the net cash that the company has made during the year, which is 3,355 crores. So the total closing cash and cash equivalents at the end of the year will be 1,185 plus 3,355, amounting to around 4,541 crores. So that is the cash that the company has on its book right now. Again, so coming back to the point where we said there is a lot of details that are interlinked between the different statements. So you will notice the closing cash and cash equivalent, the same number that would be visible in the balance sheet as well. So we saw at the start how profit after tax or profit before tax was utilized from the P&L statement. The same way cash flow and balance sheet are also closely linked with each other. So these three statements have to be read in alignment, not in isolation. And if a company is trying to cook its books, or it's often called window dressing, where a company tries to cook its books or create accounting gimmicks to show up numbers in a manner that investors would like, but it doesn't represent reality. So by linking these statements closely with each other, you should be able to make a sense. For example, the company's profits are rising, but cash flows are not reflecting the same, then it's a red flag. So these are the kind of tricks and accounting techniques that you can use to actually understand if a company is really growing. So across all the different sections of the annual report, we were focusing on the qualitative side of the business. This section was purely quantitative in nature. Of course, the notes to financial statements will again be qualitative side of the story, where they explain the backdrop of these numbers. So you have to create these mental models or connect the dots in your head as you read through the annual report, or start making your notes, and then connect these different data points across sections and make your investment insights. So in the last and final video that's going to follow, we're going to talk about an investment checklist where we help you understand or connect these dots in a slightly easier fashion. A checklist is nothing but a simple list of items that you need to keep in mind, and that's a sample checklist that we are going to talk about. You need to craft your own checklist, because like I keep saying, each investor has their own perspective, their own style of investing, and what matters to them could be very different from what matters to any other investor out there. So crafting that investment checklist by utilizing data from all of these 5 sections and across the annual report is something that would be a very interesting takeaway from this entire workshop. So thanks everybody for joining this session. We'll meet you again soon.